you're going to be looking at a few major indexes. Basically, these are bundles of companies and they show us what the market is doing today. AKA, is it going up? Is it going down? Is it trending sideways? The first one, the S&P 500. Basically, this is just a collection of 500 of the biggest companies in America. Second is the NASDAQ. This is a tech-heavy index basket of stocks, okay? Think like Google and Amazon. And then we're gonna look at the Dow, okay? This is more legacy, but it covers 30 companies in the US. You're going to Google any of those names and check if they are up or down for the day. That is your daily vibe check. The next thing we are looking at is the VIX. This is the market's fear gauge. Basically, it tells you how much fear is in the market, how nervous investors are. A low VIX means calm. A high VIX means panic. For context, so you understand what I'm talking about, in April, okay, when the tariffs were announced, the VIX spiked. And usually when we see a really sharp spike up like that, we see stock prices come down. If you follow me, then you know when stock prices come down, that's a really great buying opportunity because stocks are on sale. You can buy more with less, which means you can make more with less. So you can just Google VIX index or VIX and the chart will pop up, the one that I just showed you, and you can see if it's trending upwards or downwards or what it's doing today. Now, the next thing we are going to pay attention to is interest rates and the things that the Fed is saying. Why? Because when rates go up, borrowing money becomes more expensive, not just for you and me, but also for banks and businesses. During rate hikes, the market usually dips. During rate cuts, the market usually rallies. The next thing we're going to look at, bond yields. I just made a video about this the other day. If you haven't watched it, go back and check it out. This one is underrated, but it's huge because bond yields tell us how much return investors are expecting for not investing in the stock market. If bond yields go up, it makes stocks less attractive. So typically, stocks will fall. And if bond yields go down, money flows back into the market, pushing stock prices higher. The next thing we want to look at, earnings, okay? Every 3 months, big companies spill the tea on how much they're making or not. So big names like Apple or Meta or Amazon, they can move the whole market if they miss their earnings expectations or they exceed them. So on Google, you can search earnings calendar to see when the reports are coming out. The next thing you can look at, headlines and global news. Now, you don't need to read every news article, but start keeping your eye out for things that say inflation reports, jobs reports, geopolitical tension. If you want to learn how to use all of that information to actually build real wealth, I'm breaking it all down in my free How to Get Rich in a Recession masterclass. It's 90 minutes and it's fucking life-changing. Go and grab your spot right now, link in bio.